Good afternoon and welcome to today's webinar. My name is Simon Smith and I'm Head of Research here at FxPro. These webinars I do once every 2 weeks, looking at really the sort of fundamental drivers of FX. So I'm choosing sort of what are the big themes going on and trying to analyze where things might go into the future. Throwing together some charts from Bloomberg, so if they're not that clear, I've tried to make them as clear as I can and explain what they mean as I go along. Before I start, just to make you aware of the disclaimer, which essentially says this should not be seen as investment advice, and I'm not telling you whether to buy or sell currencies or securities. We're a broker and not authorized to undertake investment advice. And also the risk warning, which highlights that CFDs and leverage products are high risk, and when necessary you should consult your or seek independent advice. In the webinar software you should see a Q&A panel. It's available from the little drop down menu at the top of your screen. If you click on that, it's a Q&A box. If you want to ask a question during the webinar, that's great. Please keep them on topic so we can keep the flow going. I should be talking for about 25 minutes and then leaving it about 5 minutes for questions at the end. And all questions that you put in the Q&A are only seen by me, and I will answer them verbally and anonymously. And just finally, this webinar is being recorded, and I will put a recording on YouTube, all being well, but again, I won't refer to anyone by name. Just want to go through what we covered today. The euro, why is it going in higher? Why it might end? Also looking at the dollar or the prospects of Fed tapering in December, which I think are quite finely balanced, maybe more so than people are perhaps anticipating. Also looking in detail at how that might affect the dollar. I think the dynamics have changed quite substantially over the course of the past few weeks. And then just to look into 2014 and to give an idea of where things might move then, and to sort of lead into next week's webinar, which will be a little more detailed look at the prospects for currencies in 2014. Looking at the moves over the last 2 weeks, when I did the last webinar, which unfortunately didn't put on YouTube because the sound was all funny for some reason, so I apologise for that. But looking at the moves we've seen, you can see that the euro has been pretty much against the dollar. These are spot returns against the dollar. Euro has been pushing ahead once more. Most of that coming in the last 2 to 3 trading sessions. Swiss franc even stronger. Main losers have been the yen, less so the Aussie dollar, and also Canadian dollar as well. So it's really pushed higher largely on the factors we were looking at 2 weeks ago. And I think the key question, especially given the gains we've seen up to where we now sort of just above 137, is to ask the question whether there's still momentum in there, whether this rally still has legs. It's a pretty key question to be asking at this point in time. And as I said verbally, but just this chart goes from the 25th of November right up to today, 9th of December, about my lunchtime. You can see the rally we had during the press conference. So there were some expectations that the ECB could put some further measures in place, not cutting rates again. They cut rates last month. But more action on the liquidity side. I'll show you a bit later the way that has been playing into. I think a lot of people have missed this dynamic, and the people that have been caught wrong on this move, the dynamic of what's happening to liquidity and money market rates as banks have been repaying money back to the ECB. There also weren't any comments on the euro. Some were perhaps expecting that Draghi was going to mention something about the euro, but that wasn't come. So why has the euro been pushing higher? As I said at the time a month ago, the rate cut was probably the least effective option available to them. It hardly impacted money market rates, and as I show, they've actually moved higher since the rates were cut. And that means the impact actually on rates to businesses and households will probably be, well, nothing. And actually, rates to businesses and households risk actually moving higher, even though the ECB cut rates. Banks have actually been repaying long-term loans back to the ECB, and I'll show you in the next couple of charts. There are these stress tests that the ECB are conducting, called the AQR, the Asset Quality Review. And so banks have actually been wanting to get assets back, so they give assets to what's called collateral to the ECB in return for cash on a loan basis, and they have the option to get that back early, which is what they've been doing. That's pushed market interest rates higher. As I mentioned before, the Eurozone does also have a strong and rising current account surplus. So overall, the Eurozone as a whole is saving more than it's investing, and that means it doesn't have to import capital from abroad. And that's quite an important point, especially as we consider the prospects of Fed tapering. And finally, the combination of factors which I've highlighted last month: current account positive and rising with low inflation and low rates, generally more often than not has been a sort of positive combination for a currency, thinking about what we've seen in the Swiss franc and also the yen in recent years. It's not perfect, but something to bear in mind. So the excess liquidity, banks are required to hold a certain amount of cash with the ECB. As if you're a bank, or you have to hold, it used to be 2%, I think it's lower, certain proportion, what's called required reserves with the ECB over a monthly period on average. And so basically, generally banks have managed that quite tightly. But since the start of the financial crisis, the ECB has said, look, you can have as much liquidity as you want, subject to you giving us the proper collateral. So you've had this position of excess liquidity, some more liquidity over and above that they're required to hold. So normally this measure of excess liquidity would be very low, be bumbling along the bottom of this chart here. Most of the financial crisis, I could show you this in a bigger eye. I've just sort of focused in on this smaller part. This has actually been positive. What's been happening is that banks have been repaying money back to the ECB. So that has moved us from the beginning of the year, where excess liquidity was about 600 billion. So that has gone down about 2/3. So 200 billion was seen as the amount that was, below which the ECB may add more liquidity, but we're down to sort of 150 billion, which in itself has an impact of pushing money market rates higher. And the fact that we're moving lower on this excess liquidity has been one factor pushing rates higher, but also has happened because the ECB is doing these stress tests. So also the final point to note, because of this excess liquidity, is why we are seeing money market rates low. So even when rates are 0.5% before the rate cut last month, banks are lending to each other at less than 0.1% on a annualized basis on overnight money. So you can see the impact is to mean that money market rates are a lot lower than this benchmark rate from the ECB. The impact of that is that we've seen money market rates move higher. So this is a chart of 3-month money from 2013 at the beginning here, January up to now. You can see that is very simply at a high for the year. Of course, it's quite a tight range. The low at May was 0.11 and the high 0.21.5. So yes, it's a small range, but at the same time, you'll see the chart, if I haven't put it in, but the same chart for dollars will be moving lower. So you've seen this divergence. US money market rates have been nudging lower, only about 2 or 3 basis points over the same period, at the same time that euro rates have been moving higher. So it's significant because in sort of relative terms, it's quite, you can see on the chart, it's quite a significant move. So you can see that also, the fact that at the lows of last month, we are up what's called 4.04% or 4 basis points. Again, making the point that since rates have been cut, actual money market rates have been moving higher. Counter arguments. I'm just looking through some bank research this morning, so I thought I'd throw these in. Again, I'm going to talk about these a bit later. You can see that euro dollar on the dark blue line. These are from Citibank, and the 2-year rate spread. So the difference between euro 2-year interest rates. They can either be government bonds or swap rates, and those for the US here. So this blue line moving higher means for example, euro rates are moving higher than US rates. So you can see there's divergences open it here. So I'm saying actually the euro dollar has moved more than it should have done, given what's happened to relative interest rates. The second chart also shows bank stocks because it's this, banks have been, and the health of banks have been so crucial through the financial crisis. So Citibank have a sort of relative measure of bank stocks both in the US and Eurozone, and noting a sort of decentish correlation between them. But as with always these things, you can put through any two series, and quite often you get correlations. Quite often they'll be spurious, and it is what is not within that chart that explains why the divergence have happened. So it's not simply a case that suddenly this will fall down, this might fall up, or this relationship might break down permanently. So on this basis, it's worth bearing this in mind, and I'll come back to the rate argument as well, just in a little moment. And the final thing that Citibank will notice, say, well, actually things got ahead, is the economic surprise index. Now, this is an index that measures the degree to which data, inflation, growth, survey data is coming in above or below expectations. So surprise index will be rising if you are seeing data come in consistently stronger than expected. So I'm just going into my Bloomberg now, just to show you one for the US. So you can see on this US one, so then when this line is rising, US data is coming in stronger than expected versus expectations. So the expectations you see in your economic calendar on wherever you source that from. So you can see this is the relationship from the dollar. You can then remove these or do one versus the other. So what they've done here is actually take the euro one minus the US one. So it's similar, it's just a spread, the same we had for the interest rates in the previous chart. So saying actually the data is US surprises of actually outperforming Eurozone surprises. This really should have pulled euro dollar lower, but it hasn't. But I think it's pretty weak, this argument, because you can see that's broken down, number one, since September, but also the fact that the expectations adapt. So the fact that they're moving lower doesn't mean the data's worse. The fact that the expectations have adapted to the new reality. So that's another reason, perhaps, why we're seeing this divergence. So I'm giving you here some of the counter arguments that I've seen certainly in the last couple of days, and I'm going to pull those together at the end. So in terms of the views, so I think overall, I think those factors. Let me just go back to these. I will sum up at the end. I think it's worth just updating here. So the factors that pulling up the euro have been sort of largely what's happening in rates. I think the tapering is the big risk event, but certainly there are other reasons why we might see the euro pull down lower. But in general terms, if you look at the chart, certainly the technicals are still suggesting that things can move higher. But I think the main risk is what happens in the Fed later this month. I think there are decent risks that tapering is either seen or strong hints are seen towards that. So I'm just trying to bring up, as I talk, the euro dollar chart. Let me just do that now. So you can see the fact that we've broken through this trend line, which I talked about before, is a trend line that offered decent support and offering resistance to the upside. We've closed above that on a closing basis here, is relatively bullish, but certainly I think there's chance that we do see some stalling of the gains up to the 140 level. Let's deal with the other side, because I'm focusing on euro dollar here. I'm going to sort of bring it out more next week. I'm going to touch on a couple of currencies at the end of this one. I certainly think the tapering is a risk for December. Why? What's happened is that the Fed has split the difference between tapering and tightening. The big fear in September, and I'll illustrate this in the following two charts, was that if the Fed started tapering, which means buying less every month of assets, they're currently buying 85 billion, which has been doing for nearly a year now, buying less assets, the tapering has moved to 75 billion, and continuing on from there. Back in September, markets were fearing, well, if they start doing that, they're going to be putting up rates soon. And that's conversely one of the reasons why they actually didn't put up rates, but I'll talk about that in a minute. So, the fact that they've split this difference, and I'll show you why it makes tapering more likely, and I've just talked about that. And the labour market data is in queues. I was also seeing this time some chances of budget agreements as well more this month. So someone was asking, just will tapering happen this month? It's not my base case, but certainly sees the chart. So I think there's about a 40% chance of tapering. I can't type. It should be tapering. So I apologise for that. So I see a 40% chance it happens. I think the market, if you can price it, I saw a survey on Bloomberg this morning saying it's about a third. I think just under a third of analysts are looking for it. So I think probably more are seeing a greater chance than perhaps the market is. So that's worth bearing in mind. Let me just illustrate a couple of those points. This is the expectation for US rates in the middle of 2015. So this is taken from interest rate futures contracts, which gain an expectation of where the Fed funds rate will be there. So in the early part of September, the expectation was that you'd see Fed funds nearly at 1% from their current 0.25. So you can see that markets were expecting 3 rate hikes within sort of less than 2 years, or just under 2 years. Currently that is 0.27, so with Fed funds at 0.25, I think you can see they're pretty much pricing no change in Fed funds over the next 2 years. So that's a big change that's happened from September to now. So you're just making that point that the 3 rate hikes that have been priced have been removed. Someone's just asking about the impact on dollars and stock market. I'll talk about that in the next section, so hold your horses and we'll cover that. But the other thing is 10-year bonds. So that matters a lot for mortgage rates. A lot of mortgages in the US are fixed for a long time. So 10-year bonds and 5-year bonds matter a lot for that. So you can see here the peak was nearly 3% in the 10-year bond just in the early part of September. And even though I think actually the chances of tapering are pretty high at the moment, the current is still actually lower than that, 2.85. 30-year mortgage rates are about 30 basis points lower than here. So, and actually it was funny that, not funny, but notable that one of the reasons the Fed mentioned for not tapering in September, the fact that mortgage rates have moved higher. And mortgage rates have moved higher because the market was expected tapering. But they were also fearing tightening. And so again, making the point that because the Fed has actually done relatively well in saying to markets, look, don't worry, if we taper, if we stop QE, it doesn't mean rates are going to be, rising anytime soon. Relax about it. And so that's again reflected in here. And also the Fed's making the point that actually the rise in bond yields is more to do with the better economic data rather than the fear of tapering or tightening, because you can see at the same time that we've seen the 10-year bond move higher, we've seen expectations of the Fed rates actually move lower. So again, it's just making the point that this difference has been made. So coming on to the dollar, yes, tapering would be dollar positive. But it's not so much as before. Before it was because of the fear of tightening, and of course money market rates and short-term interest rates, the rates you get in terms of swap differentials are pretty key for currencies and one of the key drivers. 2-year rates, as I showed in the previous chart from Citi, and I'm going to show you in the next chart actually, is one of the ones that matter most for FX normally, even though the relationship has broken down more recently in terms of euro dollar. And the other caveat is, I guess, that markets need to remain convinced of the separation of tapering and tightening. That means that they need to keep down this expectation that rates won't start moving higher just because the Fed is stopping buying bonds. It's partly underlines why I sort of, in terms of view for next year, which I'll outline more in a week's time, is really sort of conditional dollar strength. There are a lot of people thinking that, we are going to enter a big bull phase for the dollar now. And, the fact that the US central bank is exiting quicker than the rest means that, this is the start of a great, multi-year upward trend in the dollar, which has sort of been lacking recently. I'm going to throw a dollar chart as I move away. So, we had that sort of strong, this is just a dollar index to show the big points. You see that strong uptrend about 5, 6, 7 years up to the early 2000s. You've seen a strong bit of a correction in the middle, downtrend to the middle part of 2008. And we've then held within this range we saw in the sort of depths of the financial crisis when everyone was going into dollars. We've held that range. So actually, this is more been the exception than the rule that we've seen a relatively stable dollar over the last 3.5 years, really. nearly 4 years. So on that basis, people are thinking, this has got to end, and we need to see a sort of multi-year trend higher in the dollar as the US recovers and the rest of the world languishes. I don't think the world is that simple, which I say why I see conditional dollar strength in 2014. Making the point here, a lot of the bearish views on euro dollar are sort of based, or as in positive views on the dollar, are based on the fact that we've seen this sort of divergence between what we're seeing on the two-year interest rate differential. This chart here, this is going back further than the Citibank one over the last 4 years actually. So when this moves higher, again making the point, this moves higher. Euro interest rates are moving higher relative to US ones, and is usually supportive of the currency. Should move in tandem. You can see the correlation is broken down this year as other factors have come into play, and I think the current account surplus situation has been playing as well, and the fall in excess liquidity, which has impacted money market rates. It's small, you're seeing it less on the 2-year rates, but nevertheless has been happening. So you can see why I say it's dollar positive, perhaps not much as before, because this relationship is broken down. If we're going to go back to the relative differentials there, it would suggest that euro dollar is going to go down and 10 big figures, 12 big figures, but I don't think that's going to happen because I think this relationship's broken down. Again, it's what's not in this relationship that's important. So, bottom line, that 2-year yields at the moment are having less of an influence, which is why I say it's sort of conditional dollar strength. As I say, this webinar today is really focused on the sort of majors, so it's focused on the euro and dollar. I think that's where the interesting stuff is happening at the moment. Certainly the risks for the next 2 weeks, number one, because the euro has moved higher, number two, because we have the Fed meeting on the 17th and 18th. So that's why I've focused. Other webinars, I tend to sort of focus on the other currencies as well, Aussie, yen, etc., which I've not touched on this time. But what I'm going to do next week is actually working on sort of just finalising 2014 outlook. So that will be done this week. So I really want to spend next week looking at bringing it out away from the euro and dollar and looking at the bigger picture. At the moment, even leaving aside, even with tapering, I still think the euro could push higher towards a 140 level. I think the move we're seeing on money market rates is significant. Again, tapering and tightening and splitting that out. Yes, the dollar will move higher, but I don't think it's necessarily going to be sustained early on. Would like to reverse. As I say, that 2-year rate differential is getting stretched and likely to get more so. So I think we'll see some reversal of this later on in the year. The Aussie, I think, is going to have a very rough ride next year. Could go down all the way to the 80 level on Aussie dollar. But I make the point at the beginning that trends remain shorter. If there's any, as I showed you in the dollar chart as well, we have been in a period for nearly 4 years of not multi-year trends in currencies, much shorter trends, and actually sort of relatively higher volatility than what we are seeing when markets are a lot more trended. So that even applies to the Aussie. We're not just going to go a straight line down to 80. Sterling's probably going to be weaker in the second half. It's been very much buoyed by the stronger data we've had, and that has some risks going into next year. And I think Sterling will hold up initially, but I think there are risks there. And the yen as well. A lot of people are still bearish on the yen because the reasons for being bearish haven't worked out in the second half of the year. Well, they're working out now, the last 3 to 4 weeks, but have been largely frustrated. But I think I'm sort of bearish on the yen for different reasons, which I'll talk about next week. Someone's asking, should we remain bullish? So I'll just answer that question in a second, because I've just to sum up today's webinar, then I'll deal with the question. Euro strength, I think, is likely to continue, but the Fed is the biggest risk. Strength continuing because money market rates are still nudging higher because liquidity is falling. I'd say a 40% chance the Fed does taper. That isn't so. Base case, again, you're always splitting with central banks what you think they should do. It isn't talking with someone at an investment bank today about it and what they actually will do, and you have to read the signals a lot. So if I was a Fed, I probably would taper just to bring that into the equation and let markets know it's not here forever. But the signs are perhaps not yet there. But as I said, even in September and even in the subsequent meetings, I think the decision has been finely balanced. As I said, the impact on the dollar is not going to be as strong, and sort of bringing around should remain bullish. The question where someone asked should remain bullish on dollar because Fed can announce tapering. If you want to Generally, yes, but as I said, it's not going to be as dollar bullish as would have been the case in September. So if the Fed does taper in December, absolutely you would see a pretty significant rally in the dollar, especially against the yen and probably the Aussie as well. Was But probably not as sharp as we would have seen if it hadn't done it in September. At least looking at the reactions maybe a week after. That's why I say conditional dollar strength through 2014. Just before there's a couple of questions come in, so I'm going to answer those in a minute. Just before, I'll just do summary and then go on to questions. The webinar next week is going to look solid, next year. So you can search FxPro webinars. It should, the cleverness of Google, get you to our webinars page, or you can access it from the front page. And so, same time next week, and go sort of look at the bigger picture in 2014, move it out beyond just the majors that I touched today, and look at the Aussie, the yen, and Kiwi as well. As some of you realised, you can ask questions in this little drop-down panel. As I said, I'll answer them anonymously and verbally.